In 2024, millions of Americans are set to receive $2,500 checks, and Social Security recipients will be receiving $1,900 checks on January 10th. In this update, I'll identify the eligible recipients for these payments and provide details on a settlement benefiting SSI beneficiaries. For those on SSI, I'll inform you if you qualify for the millions allocated to beneficiaries. Additionally, I'll share other important updates. If you find value in our Social Security content, please show your support by liking the video and subscribing to our channel for future updates. Now let's delve into the details. Who will be receiving the $1,900 Social Security checks on January 10th? This marks the third round of payments for 2024. While 2 payments have already been issued this year, the January 10th distribution represents the first official COLA-adjusted amount. Individuals with birthdays falling between the 1st and 10th of the month will receive their checks on Wednesday, January 10th. Share in the comments if you're aware of the adjusted amount or if this will be a surprise for you. We're eager to hear if this change will positively impact or challenge your lifestyle. Share your thoughts below. The precise amount each individual receives will vary, but with the 3.2% increase, the average payment for a retired worker in 2024 is expected to rise by around $1.57. This brings the average Social Security check for 2024 to approximately $1,884.50. It's important to note that the specific impact on your payments depends on your unique circumstances with Social Security. The distribution of these checks is scheduled for tomorrow, January 10th. Now, let's shift our focus to mitigating the burden of student loan repayments through a potential tax deduction of up to $2,500. Here's a breakdown of how it works. Before delving into the details, let's address the question: is the $2,500 tax break truly free money? Or could these funds have been allocated differently, perhaps to support Social Security recipients facing challenges due to inflation and difficult times? While the concept of something being entirely free may be debated, it's worth exploring how these funds could have been utilized in alternative ways, particularly in the context of aiding those relying on Social Security during these challenging times. Let's delve into that discussion while considering the potential different uses for this money. As millions of Americans resume student loan payments in 2023, a silver lining emerges during tax season. Interest on federal loans recommenced accruing on September 1st, and the initial payments became due in October for over 40 million individuals. Those who've embarked on the repayment journey may find solace in the opportunity to claim a federal deduction on the interest, potentially up to $2,500, without the need for itemization. To optimize this deduction, it's crucial to be aware of income limits and pertinent details regarding loan ownership and payments. For the tax year 2023, the income limit is $75,000 for single filers and $155,000 for joint filers. The deduction phases out when modified adjusted gross income exceeds $90,000 for single filers and $185,000 for joint filers. It's important to note that only single individuals, not married and filing separately, who are not claimed as dependents by someone else, can claim this deduction. Additionally, to qualify, you must be legally obligated to pay interest on a qualified student loan and have made payments toward it. The scope of deductible expenses extends beyond the interest on federal and private loans to include the loan origination fee. This fee, charged by the lender when the loan is made, must be applied to money, not property or services, and is treated as interest that accrues over the loan's lifespan. As you navigate through the intricacies of student loan deductions, understanding these key details will empower you to make informed decisions during tax season. Without delving too deeply into the specifics, if you believe this information may apply to your situation, I encourage you to look it up for further clarification. The potential tax deduction of up to $2,500 per person, while beneficial for some, raises questions about alternative uses for these funds. I won't elaborate further on this point and will proceed to discuss a significant settlement that will bring relief to Supplemental Security Income, SSI, beneficiaries. A recent settlement is poised to provide assistance to over 2 million SSI recipients, including many individuals with disabilities who experienced reductions or discontinuations of their benefits during the pandemic. As part of this agreement, the Social Security Administration has committed to automatically waiving overpayments that occurred between March and September 2020. Furthermore, Individuals who have already repaid these funds will be refunded accordingly. The settlement also offers remedies for those who faced benefit overpayments as recently as April 2023. These measures are integral components of a nationwide settlement resulting from a federal lawsuit filed in 2021 known as Campos versus Kikazi. The lawsuit accused the Social Security Administration of unjustly cutting or discontinuing SSI benefits during the pandemic. Allegations included beneficiaries being penalized due to their inability to provide information or challenge agency decisions as certain paperwork processing was halted, and field offices remained closed for over 2 years during the pandemic. This settlement aims to rectify these issues and bring relief to those affected by the disruptions in SSI benefits. The lawsuit highlighted instances of injustice, such as a woman deemed ineligible for SSI due to the agency's miscounting of funds she received for an adopted child with disabilities. Another plaintiff faced eligibility challenges when health concerns and stay-at-home orders prevented her from accessing funds in her bank accounts. These cases represent a broader issue affecting millions of SSI recipients, as noted by advocacy groups like the New York Legal Assistance Group, Justice in Aging, and the law firm Arnold & Porter. The settlement, in essence, rectifies what the Social Security Administration, SSA, should have done from the outset, ensuring that SSI recipients are not unfairly penalized or denied benefits crucial for their survival due to circumstances beyond their control. By reimbursing those who had their benefits reduced or discontinued during the pandemic, this settlement offers significant relief to SSI recipients still grappling with the challenges of a global health crisis. As part of the agreement, nearly 250,000 SSI recipients are anticipated to have their benefits automatically credited back to their accounts. Moreover, the SSA will issue internal guidance in late February, emphasizing that circumstances related to COVID-19 should be considered when addressing overpayments that occurred between March 2020 and April 2023. This proactive step aims to prevent similar issues in the future and acknowledges the unique challenges faced by SSI recipients during the specified period. By spring 2025, the Social Security Administration, SSA, plans to dispatch notices to Supplemental Security Income, SSI recipients who experienced overpayments between March 2020 and April 2023. These notices will provide details on the process for requesting a waiver and outline relevant COVID-19 related factors. Approximately 2 million additional SSI recipients are expected to benefit from this initiative. We invite you to share in the comments below if you are one of the individuals whose SSI benefits were interrupted. Are you anticipating a reimbursement check to assist during those challenging times? Your insights are valuable to us. The challenges with the SSA highlight ongoing issues within this extensive bureaucratic institution, creating a series of problems. While finding solutions to these challenges remains complex, it is essential to stay informed about developments. That concludes today's news update. For more insights into the current congressional efforts addressing SSA overpayments, click on the video above. In that video,